Disha madam? Okay. So good evening, all the participants. We are having the series on Ind AS and audits. And today we have a subject on deep dive into audit planning. And we have got a good speaker for that, CA Disha Maheshwari. And before starting the seminar, I'll request Mishra ji to play the ICM motto song, and I'll request all of the participants to place your hands on your heart.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैत 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 एतद्वैत.
Thank you, Mishra ji. Thanks, all of you. As the saying goes, well begun is half done. Likewise, the audit planned well, we can be rest assured that audit goes well. So today we have with us the speaker, CA Disha Maheshwari, the coordinator, CA Dilip Borse from Nashik, and we also have got presence of our past chairman, CA Murtuza Kanchwala, and chairman CA Ankit Rathi from the WIRC. So I'll request our chairman WIRC to give his opening remarks.
Very good evening. It's indeed pleasure to be here with you all in this virtual room. At the outset, let me first recognize the presence of respected honorable past chairman Murtuza Kachwalaji, who is sitting with me in chairman cabin only. Let me also recognize the presence of Vikasa chairperson of our Western India Regional Council, Piyushji Chandak, our today faculty, Disha madam. Disha madam, thank you so much. Despite of your so much busy schedule, you accept our invitation and being agreed to share your valuable knowledge with our participants. I am again thankful to you. Let me also thanks to Dilip Bhai for being agreed to coordinate this today webinar. Dilip Bhai, thank you so much. Friends, let me tell you, sometime before we all are sitting, me, Murtuza Bhai, Piyush and other council member and discussing what is the importance of audit, planning, accounting, standard implementation and all that. Then we come to know that the expectation of our stakeholder and regulator is very, very high from each one of us. So what we thought we need to deliver more and more good lecture or more and more good content to our members so they can update ourselves or deliver best out of best which they are doing in regular practice. So we thought, why we not a regular series in which we teach our members or we update our member about the Ind AS and audit planning and audit process. So what I can say, our today webinar is very, very important because Disha madam is all covering about the audit planning, what is the importance of audit planning. When we, even myself is doing the various audit and due diligence for the various small and mid-sized company, then come to know there is a various loophole at the time of doing the audit. When we check the financial statement, then we come to know various auditor or various chartered accountant are not following proper accounting standard or auditing guideline. So what I request to each one of you, this is the high time, as already Ministry of Corporate Affairs already adopted artificial intelligence in their V3 portal. So there is no far, or we can say soon we get what we can say, we keep starting or we get starting keep notice from the Department of Ministry of Corporate Affairs about the small mistakes which we are doing at the time of finalization of the financial statement. So what my request to each one of you, please listen this today webinar carefully so we can update ourselves with the content of audit planning. Audit planning is the what I can say crucial process at the time of audit. If we do planning properly, so we can execute the audit also smoothly. With this, I request Murtuza Bhai for the address.
Thank you, Chairman. Good afternoon, good evening to everyone. Let me first thank the dynamic Chairman of WRC, Ankit Bhai. Thank you for such a lot of work which is happening in WRC this year. Also, the Vikasa Chairman, Piyush Chandak. Piyush Bhai, thank you for spending so much time in Bombay also and being with the students and doing such good work in the students this thing. Let me also thank Disha Madam. Madam, thank you for accepting our invitation, and Dilip ji for coordinating this program today. Again, like Chairman mentioned, I think earlier maybe we were spending a little less time on planning and spending more time on field work. And then again, we had no time for reporting. But now I think when we talk about, we say at least, if not more, 30%, 35% time to be spent on planning, and then possibly get into the field work or real work or getting into the ground, and then possibly again keep some time for the final product, the output which you're going to give, the reporting, and depending on what we are doing. But if it is a Companies Act, then again, whether it is a modified report, unmodified report, whether it is an emphasis of matter or adverse opinion, I think, or whether it is a key audit matter, so much more, and the jury is out and you're seeing so much of NAFRA reports and the disciplinary committee coming up. So there is very less chance of doing any mistake towards the end result as well. But again, coming to planning, I think the standards are so very clear, the essays, and I'm sure Disha Madam will cover the standards. But like understanding the nature of business, understanding the IT environment of the client where we're doing the work, I think that is important. Understanding the laws and regulation in the areas which you're going to do the audit. And then possibly once you know that, whether you're going to do a lot of manual work, whether you're going to do a lot of analytics and querying and using some tools, and depending on that, whether you're doing the whole population, using templates. But again, still, when you select the samples as per sampling standard, then there is a test of compliance and there is a test of substantive. For purchase vouching, sale vouching, bank payment, you need templates. And even for a data's confirmation of a bank reconciliation. So I think, and those become your crucial working paper, as I call. And I always say in all my sessions, work not documented is work not done. And I think the most important is the templates and the working paper, the planning templates and the testing templates. If we can show that, then we know that, okay, I have selected so-and-so sample on so-and-so basis. And which means if there is something happening beyond that sample, and if I have done a statistical sampling, then I cannot be blamed for everything. So it is very, very important. How did you select the sample and which did you select, and document those. So I am sure it is going to be an interesting session. So with that, again, thank you, and over to you, Piyush Bhai.
Thank you very much, sir. So we started with well begun is half done for planning. And as rightly said by our Honorable Chairman, that we need to do a lot of introspection while performing our audit business, because audit is a serious business now, and it is taken seriously by all the stakeholders, including the government agencies and all the regulators as well. Now, as rightly said by our past chairman also in detail, that if audit is not documented, it is not done. So considering all those outlines, definitely we have already set the tone for the today's seminar, and I'm very much confident that the speaker will take you through with all the intricacies of the audit. And with this, I thank all of you for being with us, and I'll request that continue to be with us always, and I'll hand over the session to the speaker, please. Thank you very much, madam. Thank you.
Thank you, Piyush, and good evening to all.
Madam, sorry. I request Dilip bhai, if you can quickly introduce our today faculty.
Oh, sorry.
Yes, sir. Thank you, sir. It is my proud privilege to introduce today's learning speaker for the seminar, Ms. Disha Maheshwari ma'am. Disha ma'am is an associate partner in Price Waterhoopers and has over 15 years of experience in providing assurance services to Indian and multinational clients in the field of manufacturing, engineering, technology, and telecommunication sector. She has significant experience with multiple financial reporting frameworks, IFRS, Ind AS, and Indian GAAP. She worked in UK and Bahrain offices of PwC. Ma'am has also conducted various internal trainings across offices on various topics relating to accounting and auditing. Apart from ICA member, her professional qualification includes diploma in IFRS, post-graduation MCOM degree from University of Pune. With this brief introduction, I request sir to take the program further. Thank you.
Thank you, Dilip Bhai, and I am sorry, madam. It is very important that the session attendees should know who is going to speak before them. So thanks a lot for bearing with us. Thank you very much. And over to you, madam, now. Thank you.
Thank you, Dilipji, for the kind introduction. I think thanks, Piyushji. And for setting the context, I think thank you, Ankitji and Murtaza. Sir, I think I cannot agree less on the importance of planning an audit. We have, as you mentioned, we have seen regulatory inspections. We've seen the kind of comments that they are coming out with. Uh, Documentation, as you said, absolutely work not documented is not done. I think that's our motto across. And I think that goes a long, long way in substantiating and being able to, give, comfort to the regulators and to the public at large as to how we are doing our audits, how we have reached to certain conclusions, what was the basis of all of that. I think unless that is documented in the files, in our files, it doesn't stand, well with either the regulators or the public at large. Uh, so I think with that, I think I begin with the session. Can I share my screen?
Yes, ma'am.
Yes, madam, you can share your screen.
Yeah. Is it visible?
It is visible now. Just you have to run the slideshow, ma'am.
Yeah. Is that okay?
Yes, madam, that is okay now.
Yes.
Okay. So, just a brief agenda first on what we would be covering. Of course, the topic is the planning for audits. So we would be covering, all the different aspects which are a part of audit planning. That is like setting materiality, identifying risks, assessing the risks of misstatement, and our responses. How do we, plan our responses to the assessed risk? There is a famous saying. I think I would like to start with that. Is that he who fails to plan is planning to fail. I think it was by Winston Churchill. And it's very, very important in audit as well. I mean, it is important in our day to day lives. I think, a simple thing like if we are planning for a meeting with the client, as simple as that, we will need to uh, uh, kind of plan for that meeting, right? You need to plan an agenda for the meeting. Sorry, is my screen, is the PPT still visible?
तो आपका वापस से हाँ स्क्रीन शेयर करिए आपका पीपीटी शेयर है मैम
You can see the PPT, right?
नहीं मैडम
No?
वापस से शेयर स्क्रीन करिए मैम
Okay.
हाँ ओके
Screen. Yes. आ गया अभी.
Yeah. So it's visible, right, my PPT?
Yes, ma'am.
Yeah. So as I was saying, if a simple client meeting also we need to plan, right? We need to plan what are we going to discuss, what's going to be the agenda, do we have all the material in place, how are we going to reach the meeting, client place, you will plan on how would you go by cab, would you go uh, by your vehicle, is it raining, is it not, do you need to carry an umbrella, not, all of that, anything requires planning. And when simple things like that require a lot of planning, a simple thing as in a meeting with the client, I'm sure, when we are giving our audit opinion, that is a very big responsibility that we have, in giving opinion on the financial statements. Of course, it is very, very important that we plan the audit properly, because without a clear plan, I think we are clearly setting up ourselves for failure in audit opinion. Because in our audit, the final outcome of our audit is audit opinion, right? And there are risks involved even in an audit. So to just look at some of the risks. What is audit risk? Audit risk is basically the risk of issuing an inappropriate audit opinion on the financial statements, right? And this is just, I just want to set the context. I know audit risk is not our topic today, but it's very important to understand why audit plan is important. The components of audit risk, as we know, there are inherent risks, there are control risks, there is a detection risk, right? So, inherent risk and control risks, all, the function of that is our risk of material misstatement. And of course, detection risk is the risk that our audit procedures will not be able to detect that misstatement. And when we are doing an audit, reducing audit risk to zero is not possible. But of course, it's possible to reduce it to an acceptable level, and planning plays a very important role there if we want to reduce our audit risk to an acceptable level, and uh, do an audit which is efficient as well as high quality. If we were to think of when should we actually start planning for an audit, what comes to mind? To my mind, audit planning needs to start immediately when you finish the audit of the previous year. You need to start planning for the next year's audit. And having said that, it is not a one time activity. It is not something that we will do at the beginning of the audit and that's it. It is an iterative process. As and when we gather more information, as we gather more facts, we will have to keep updating our audit plan according to whatever information we have received. So it's a like a continuous process. It's not like we do our audit plan and then that's aside and we do our audit procedures. It's going to be continuous throughout the audit. So why is audit planning so important? One is obviously to reduce our audit risk, to be able to do a well planned audit which will address the risk of material misstatement. It will help us do an audit in an effective and efficient manner, right? Because we cannot do 100% testing, right? We neither are we paid for it, neither I mean the remuneration does not give us, and neither is it feasible to do 100% testing, right? So actually audit planning will help us to devote appropriate attention to the important areas, to identify where is the risk, what are the important areas that we need to focus on. We can identify potential problems early on during the audit, and so that we have adequate time and management has adequate time to address those issues. It also helps in our own resource management of the firm, that we can assess by assessing what how complex the audit is, or what are which industry the audit client is, and other information. We can actually select an appropriate engagement audit team who has the relevant experience to handle those complexities which are there for a particular client. It also helps us plan use of experts or specialists. Say if there is too much of IT controls, IT dependencies, or systems and all are very important. You would want to ensure that your technology assurance people are onboarded on the team early on, or if there is business combination or there's acquisitions and there are valuations involved, you would want experts with respect to valuation being onboarded on the team on a timely basis. All of these actually is a part of audit plan. So if you directly jump into an audit and then later on realize, oh, that's, we need to involve these specialists or experts, they may not really be available to you on a timely basis. So resource management, it does help. Performance management of an engagement, like how do you it helps to provide benchmarks against which you can assess the progress of audit. You can assess the performance of your team members, which will go a long way in ensuring at the end that we have had a good foundation for we've laid a good foundation for a successful audit, and which in turn really provides confidence and enhances the reliability of the financial statements and internal controls on which we are reporting. So that's broadly the importance of audit. Now, there are account auditing standards issued which help us in ensuring we are doing everything that's required for having a good audit plan in place. And I would say these are everything in the 300 series of auditing standards, 300, 315, 320, 330. All of these are standards which will help us to effectively plan our audit. And I would say that if we apply these standards in letter and spirit, you can be rest assured that your audit would stand the test of scrutiny by any regulator. And if you read these standards, these there are mandatory requirements in the standard, uh, and there's a lot of focus on documentation. In fact, every standard there's a separate section on documentation, which itself, is indicative that while we do all these procedures, it is also important that all of this is documented in our files appropriately, so that when the regulator or when an independent person comes to review our files, they exactly know how did we plan our audit, what were the kind of judgments we used in that, how did we apply it, how did we arrive at certain, how did we identify the risk of misstatements, and how did we ensure that our audit responses and planned procedures really address those risks. While all of this may be done, and I think in any audit we do have discussions with the engagement team on all of this. It's very important that we document all of this using the checklists. And I've seen there is a lot of there's a guidance note of the on the use of these or templates for these checklists which are available, which the institute has issued. I think that is a good base to use. For our documentation, and I would encourage that we use those checklists, we use those templates. Of course, we can enhance wherever you think it's necessary and appropriate for a particular engagement. You can do that, but at a minimum and as a base, I think those are good to use, and important to use, in fact, all those templates and checklists which we have. So keep in mind that anything, all these SA 300s, which 300 series, when you're doing planning, you're going through them, you're ensuring that you are following all the procedures mentioned, and you're also actually documenting all of that. And we will discuss this in further detail in the session today. So, overall, if you're to see an overall audit plan view, it starts with certain initial procedures that we do. That's acceptance procedures, you mobilize your engagement team, independence assessment, terms of engagement. I'll speak a little bit about each one of this in the further slides, but to give an overview, you start with initial procedures, then you have your risk assessment process, which is basically to understand the entity, its environment, set up your materiality, identify where the risks are, assess risks of material misstatements, uh, the overall risk assessment activities. That's the second thing you would do. And third thing you would do is you develop an audit plan that responds to those risks that you've identified. So basically, setting up whether you would do a controls approach, a controls based approach, a substantive approach, or a combination of controls and substantive. What level of comfort would you take from controls? What level of comfort you take from substantive? All of that is you would plan basis your risk assessment process that you've carried out, and then you would actually perform those tests and then report. So the standards on basically the 500 series actually of standards covers all the execution work, the 700 series all the reporting work, and of course the 600 is all use of experts and in the audit. So that's basically how the standards are, and I think if we follow these standards and we follow the requirements of these standards along with documentation, as I said, they would stand the test of any scrutiny by any regulator. So let's look at some of the initial procedures. This is a very important, very, very important in planning our audits. You know, some of the preliminary engagement activities, the first of it being, performing your acceptance and continuance procedures. So, we have a duty to uphold, of course, public trust. And, more often than not, we have always seen that negative actions of clients can sometimes rebound on us as auditors and damaging our reputation. And therefore it's very important that we prevent that by vetting our clients properly. And at every stage of engagement, at initial acceptance of clients obviously, but also continuing clients, or if there is any event that has triggered, say for example, change in shareholders, change in ownership, all of that would require that you reevaluate your procedures with respect to continuance of the client. Now, some the procedures that we follow for accepting is not only for accepting of the clients, as I said, also continuance of client, but also for engagements. Not only of the clients, but also engagements. Sometimes you have new engagements that come up on your existing client, like non-audit engagements or some other engagements. Your acceptance decisions are crucial in that case, because new clients or engagements do pose a threat, sometimes to objectivity. Your independence could be at threat, so they need to be properly evaluated. The new engagements also for existing clients. And we've seen recently, most of y'all would have seen a lot of debate going around in the profession of whether we should completely stop non-audit work on audit clients. The NFRA reviewers, you'll see they have a lot of focus on what non-audit work we're doing on audit clients, and whether that is impacting our independence and objectivity. So it's absolutely essential that any engagement that we are taking up on our existing clients, also we are doing a proper assessment of accepting that engagement. And some of the things that you would keep in mind when you're doing your acceptance of clients is basically assessment of client integrity. That is, you do background checks on your clients key management personnel. If there's any negative news in the media, or what is the client's reputation, how is it with respect to compliance with laws, regulations. You'd want to do an assessment of that, an assessment of the client's financial stability, analyzing if there are signs of financial distress. uh, would going concern become an issue for them? How is the client's governance and management's attitude, because tone at the top actually matters a lot. uh, with how is their attitude with respect to controls, ethical practices, financial reporting responsibilities, and all the governance structure around that. Uh, what you must also actually, while we do evaluate on client front all of this, we should also evaluate whether consideration on the audit firm's capacity. Do we have availability of adequate resources to be able to serve the client properly? If we have appropriate skills and experience within the firm, or we can use other experts, but do we have them? Do we have enough knowledge and experience on handling that kind of industry, uh, or the scale at which the client is? All of that needs to be evaluated. So internally, firm capacity, the Companies Act requirements on the limits of audit and all, also we need to assess when we are taking up a client. Then you also evaluate, as I said, the engagement risk, any risk associated with that particular engagement. So it can be not a statutory audit, but in addition to statutory audit, some other engagement, some certification, some other non-audit work. So you need to assess whether there is any risk associated with that, with that engagement. Compliance with ethical requirements. Of course, we are all bound by independence and the code of ethics. And we should ensure that there are no possible potential conflicts of interest that may arise by continuing with the engagement or the client. Uh, and for this, I mean, documentation, I think throughout today's session, I will, keep on repeating after everything, that documentation of all of this. How did you come to a conclusion of accepting a client also needs to be documented. For this, probably you can use, a checklist, or, with some of these, I've tried to put down some of the factors that you could consider in your checklist. As I said, ICAI has also issued checklists. You can use that. You can use basis your experience of senior partners in the firm as to what all criterias actually matter while accepting a client. You can all have that as a part of a checklist, which we fill up as a part of our acceptance process and a continuance process. So, for example, are there any concerns regarding the ownership or key management at the client's place? Is there too much domination of a few or one individual at the client's place? How aggressive are their accounting policies? Is there a doubt about the entity's ability to continue as a going concern? Were there qualification and previous year reports? What has management done? Has management taken any actions to rectify those qualifications? Is the IT environment very complex at the client's end? What is management's attitude towards internal controls, financial reporting? Do we see a challenge over there? These are some of the questions which should be answered, documented. Uh, all of this will help, whether we did some background checks, did we find anything that is worrying? Is there any significant litigation which is available in public domain which we are aware of, or substantial client's reputation? Financial condition, is there a concern? All of this, you put it in a question form, you answer those. Based on the answers, you would be able to come to a conclusion whether that's a high risk client or it's not a very high risk client, it's a low risk client or a medium risk client. And then accordingly, whether you're accepting the client or you're not accepting the client, or accepting the engagement, or would be best not to accept the engagement. And you can put down your decision with respect to that. Now, what happens with this is when there are inspections, there by regulators or reviews. You have a document to show that you did adequate procedures uh, and checks before accepting a client or an engagement. So that is on client acceptance. Similarly, if I was to just go back, was on the independence. The second is independence. Um, I think independence is fundamental to our profession. We all agree that auditors have to be unbiased when they're providing an audit opinion. There is tremendous focus of the regulators on the independence aspect of auditors. And the fundamental principle of objectivity imposes an obligation of each of the partners as well as the staff working on the engagement not to compromise the professional judgment or because of any bias, conflict of interest, or any other kind of influence which may have. What's important to note here is that being independent and also being seen as independent is absolutely essential. Now, so that means, there is independence of mind and there is independence in appearance as well. In mind, you should be independent. There should be nothing which will impact or will create a bias in your judgment. But what is also important is the appearance. How independent is the auditor appearing to the outside world or to the users of the financial statements? Because in the past we have debated that, okay, within a firm we are using Chinese, there are Chinese walls, there is a team doing audit, there is a team doing some other non-audit work, there is a Chinese wall, the two teams are not talking to each other. In your mind you're independent, and or the auditor is independent, the team is independent, but maybe to the outside world it does not seem to be independent, because the same firm is providing both the services that can create conflict of interest. So, and that's where the challenges come up. It becomes very difficult to substantiate what kind of controls internally you have to ensure independence. So it's very important that you appear also to be independent. For that public trust to be there in the firm, there needs to be even appearance of independence. Now, how do we ensure that the team, how do we demonstrate all of this on our files, that we have taken care of independence, whether the partners of the firm are independent, the staff working on the client is independent, and does independent mean? That for the staff, if I'm a staff doing work on an audit, I or my immediate family members and relatives are not indebted to the audit client, right? We are not having any, my relatives are not directors or in employment of the audit client. We need to assess that. We do not have substantial interest. And when I say we, I mean us, me and my relatives, my close family members, they don't have substantial interest on the audit client. uh, I or my immediate team member or family members do not serve as trustees of a trust or an executor of an estate of which we are doing audit, which is our audit client. And lastly, we do not accept any favors, whether, be it any amount, no favors, no gifts from an audit client, other than, which are in token in nature, which you may accept, but otherwise we are not accepting. All of this is important. Now, all of this is important that we demonstrate this in the file, that each of the audit team members has confirmed on this. So you send out an email asking all the team members to confirm that they are independent on all these fronts, any other front like so. So that would really, when the regulators come or when the outside comes, that whether your team members were independent, whether the firm was independent, the partners of the firm are independent. So all of this also needs to, you need to ensure that there's adequate evidence on the file, that uh, adequate steps and measures were taken to ensure that the team members that are plotted on the audit were independent. They do understand, also we need to ensure that each of the team members on the audit understands code of ethics, has read the code of ethics, understands the code of ethics. While it is a professional, uh, being in this profession, it's a requirement. But to demonstrate that all this is done, it is absolutely essential that all of this is evidenced in writing, where the team members have confirmed that they understand code of ethics, they've read code of ethics, and they are adhering to the code of ethics. So all of this you can do by way of, sending out emails, keeping those emails on file, where each team member has confirmed that there is no conflict he or she is having. The partners have confirmed that they don't have any conflicts um, with the client. So that's important activity. Then you have ensuring engagement letter is entered into with the client. absolutely essential again that the terms of the engagement or terms of the audit are agreed uh, with our clients. They understand their responsibility with respect to financial statements. They understand our scope of work. They've agreed to the fees that we are going to charge. All of that is absolutely essential again to safeguard. It is for safeguarding ourselves that we ensure that the engagement letter, the terms of the engagement are appropriately entered with the client before we start any work on the audit front. So these are some of the preliminary engagement activities and before you start the audit of the firm. Then if we were to move on to the key elements of the audit plan. Sorry. So again, these are covered by standards 315, SA 315, 320 on materiality, 330 on your audit strategy and plan. So we need to understand the client business and industry. We need to assess the risk of material misstatement, understanding internal controlled environment, establishing the materiality limits, and then developing an audit strategy plan with a proper resource allocation. Again, documentation, keeping detailed records of all of this is absolutely essential. Now, materiality, I'm just taking up materiality earlier than assessing risk of material misstatement because the risk of material misstatement is a larger topic, I think. So I'm just, while this is 320 and that's 315, I think I'm going with 320 first, just for ease. Setting up of materiality. Now, why is materiality so important in our audit? Basically, the question comes back to the purpose of the audit, which is to ensure that the financials are free of material misstatements. I'm not going to be, as an auditor, bothered about every misstatement, every small misstatement, every small theft, of a pen or a notepad or things like that. I'm not concerned. What we are concerned is with material misstatements, anything that is material. And when is a misstatement or even omission is considered as misstatement is material. If we read the standard and the definition, it is material if they individually or in aggregate, that is one misstatement or in aggregate, many misstatements that you identify could reasonably be expected to influence the economic decisions of the users based on the financial statements. Again, important to note is the economic decisions, not all your decisions. It is economic decisions of the users. Now, the users of the financial statements generally are the shareholders of the company. What could be the economic decisions? What decisions do they take? They have cash, they've invested in the company. Their decisions are mainly either to buy or to sell their investment or to hold on to the investments. These are generally the economic decisions. But the challenge that comes and is that the shareholders are could be there are variety of shareholders. They could be fund managers or they could be your mom, dad, who are shareholders and users of the financial statement. So there are different people, and materiality is of course relative. It's a relative term. It's not a clear a term as such. It's relative. Something for me could be material, for you could not be material. For a investment fund manager, it may not be material, but for as I said, your individual shareholders, it could be material. So that's where the tricky part comes in, and we do not set materiality for each individual users. That's not possible. So we do it for a group of users, and that's where the judgment about materiality is. Like, what would be the right level of materiality, so that as a group, the users of the financial statements can rely on the financial statements. So, that's the tricky part, and that's where again it's a big judgment needs to be documented in the file, absolutely, on how did we arrive at the materiality. for the audit. Now, if you set the materiality too high, your audit procedures will fail to identify misstatements. If you set the materiality too low, you would end up doing a lot of work that is unnecessary for the audit, spending much more time than required. As I said, we do not get remunerated for that, to do extra work. So it's absolutely essential that we set the materiality levels right. And here it is absolutely essential that you have these detailed discussions with your engagement leader or the partner, uh, because their experience and their insights are going to be very helpful in determining an appropriate level of materiality. Because there are qualitative aspects to be considered for materiality, there are quantitative aspects to be considered for materiality, and that's where the experience of a partner or senior team members comes into play, where that helps in determining the right level of materiality. uh, so as I said, these judgments, these are absolutely judgmental. It needs to be documented on how did you arrive at a particular level of materiality for your client. Now, how, I mean, there is one determining materiality, and then there's a performance materiality. So one is materiality at an overall financial statement level as a whole, that you will determine, and it's generally based on certain benchmarks. You could consider profit as a benchmark, or revenue as a benchmark, or assets as a benchmark, depending on what your client's business is, where are they in their journey. Performance materiality is, of course, set at a lower level than the overall materiality, mainly to uh, you know to reduce the risk of aggregation of misstatements that comes up. And that performance materiality is generally the materiality we use for performing our work, to determine whether we'll scope a particular financial statement line item or not. You use your performance materiality, and to also assess the corrected misstatements later on. We'll see how that comes into play, but those are broadly the levels of materiality that you will set up. Once that is done, I mean, as I said, benchmarks, it really depends on the nature of the entity. Generally, for profit making entities, profit would be the benchmark. However, for certain entities which are, say, in an early stage, they are still in the capitalization stage, they've not yet started the business, they've not yet started selling, but they are setting up a plant, and all, you would then take assets as a benchmark. If they are cost plus entities, like they're cost centers, for the group. For example, a lot of outsourcing centers are there, where based on transfer pricing regulations and other agreements between the group and the entities, there is a fixed margin that they maintain. So you have fixed profit. So you have cost. You will take 10%, 14%, whatever is arm's length margin, you would take that margin, and that's what's the revenue would be there. Now, for these kind of entities, maybe profit is not really appropriate benchmark, or it's not relevant, because you're always going to have 10 or 14 or whatever percentage profit. So maybe cost is a better benchmark for such kind of entities to take. And generally your materiality would be a percentage of the benchmark. So in the profession, while it's not a written rule anyway, but as a profession, we've set up, there are certain, given kind of ranges. Profit generally 5 to 10% is considered appropriate. For revenue or assets, anything between 1 to 3%. So these are more indicative. Each of your firm or partners could have based on their judgments, their knowledge of the business, their experience, could determine a range between them. But overall, at a professional level, these are generally the ranges between which materiality levels are set. Uh, so that's how. And in setting of materiality, I think an important otherwise thing is also that these benchmarks, they should be relatively stable. When they are too volatile, it becomes difficult to set materiality based on that. So one year you're having a profit of 20%, next year you're having a loss of 5%. Too much of volatility, it becomes difficult to set it to consider it as a benchmark, and then you look for alternative benchmarks which are more stable in nature. Other thing we should keep in mind is we should normalize the benchmark. So, for example, if there are one-time items or unusual, so just in a particular year there is sale of land, which is uh, not a usual kind of a transaction which will be year on year. If there is a big gain on account of which the profit has significantly increased, you would want to exclude that from the profit and then set your benchmark for materiality, because that's just a one-off transaction, and that one-off transaction is unusual or outside the normal course of business. So you'd want to exclude that one-off items and then set your materiality, so that you do appropriate level of work to arrive at your audit opinion. Our materiality again is set at the beginning of the audit, but having said that, you may have to revise it during the audit, as in when, if you finalize on your misstatements, you identify misstatements, there are adjustments to the financial statements, you will want to kind of adjust or relook at whether your materiality levels that you set during the planning stage are still appropriate. So you need to keep revisiting and revising your materiality limits where required. So it's not that once you set the materiality at the beginning of the audit, you just have to follow that. In fact, it's a requirement that you reassess that as and when you progress in your audit, and if need be, you calculate your materiality. Again, the walk or the reason why materiality has been reassessed needs to be appropriately documented in the file. So if you started with something and you're reassessing or you're revising your materiality, you need to document the reasons that led to the change in that materiality. And this materiality actually will help uh, you in how do you assess misstatements and all. So all of that materiality helps in all of that. So I think three important aspects which I would say is determining materiality, performance materiality while planning the audit appropriately and at appropriate level with involvement of seniors. Two is revision of that materiality if required as and when audit progresses. And the third is documentation of our judgments that we have used is very critical, because it is a professional judgment we are making when we are determining materiality. There are no hard and fast rules for materiality. It's all a judgment. So that's how materiality plays an important role. As I said, it will ensure that you're doing the right level of work. Too high a materiality, you will have a risk of not identifying material misstatements. Too low a materiality, you would be ending up doing a lot of work. So setting the right level is absolutely essential for a well planned audit. Then moving forward is identifying and assessing the risk of material misstatement, mainly covered by ISA 315. Standard on Auditing 315. Uh, so, and this is a very big, I mean, it's a very big standard if you read. A lot of guidance, lot of explanatory material in the standard to help identify and assess risks of misstatement. Uh, Now, it is our responsibility to identify the risk of material misstatement through understanding of the entity, its environment, and internal control. So basically, it talks about you do your risk assessment procedures, then you need to do an understanding of the entity and its environment. You do an understanding of internal controls. And if you diligently follow it, you will not miss out on any risk of identifying a risk of material misstatements. Now, let's look at some of that a little bit more in detail. Risk assessment procedures. It basically talks about doing inquiries with management. And when we say inquiries with management, it is not only with the finance team, but you need to go beyond the finance team. You need to have discussions with internal auditors, the legal counsel, the purchase department, the sales personnel, the marketing personnel. All of this is very important because you'll gather a lot of information, and we can look at some of the examples. For example, having detailed discussions with in-house legal counsel could help you identify risks of litigations which are ongoing or possible litigations. Having discussions with marketing personnel would help you identify new contracts which may have been entered and may have different terms of sale which may impact your revenue recognition. Discussion with internal auditors, of course, is very important. You identify what are the risks or what are the observations of internal auditors. You read through their internal audit reports. You identify if they have identified any fraud risk or other risk of misstatement, and then you can obviously you need to modify your audit plan to ensure that you're taking care of all of those identified misstatements or identified risks into your audit plan. So having these discussions outside of the finance function is absolutely critical. Analytical procedures are another way of identifying misstatements, risk of misstatement. And analytical procedures help in identifying any unusual transactions or unexpected relationship. It could be financial, it could be non-financial. For example, sales and volume of goods sold. If you look at them, you would know if there is something unusual in the reported revenue number, or if production has increased. If production has increased because of the production data, you would expect direct costs like electricity, maybe consumables, and other things to also increase in proportion. So all these analytical procedures between financial, non-financial, or financial between P&L and balance sheet will help you identifying any unusual transactions, unusual relationships that you need to focus on during your audit. Of course, the information that we gather through inquiries with management, you need to do some procedures around inspecting documents and observing certain things to ensure you corroborate all of that. Also, in your risk assessment procedures, you would consider what all information you obtained in your acceptance and continuance, or any information you obtained in other engagements that you performed, or any previous year's audits that you performed. It has to be a holistic way of identifying misstatement, considering all this information rather than in bits and pieces. So, if you speak about analytical procedures, which is kind of important, I wanted to give a kind of example. If you can look at the balance sheet and the profit and loss statement, this is an initial balance sheet profit and loss statement that you may get from the client. And if you were to do analytical procedures on this, if you look at some of the balances, maybe I know people are on mute, but if there is a way of putting it in the comment box, if you see anything unusual, which you can put in your comments box, looking at the balance sheet numbers and the P&L numbers, anything unusual that you notice in this? I'll just take a minute for you to go through it and give your comments. The CWEB balance, right, that substantially increased. PBT is same, right? Is the screen not visible? I think other income has substantially increased. That's also right. So I think broadly, yes, I think you all are getting the point. Is risk assessment analytics. You look at the preliminary numbers, you look at some relationships that seem unusual, uh, And if I was to say that, okay, through inquiries or through discussions with other people, we've got information that there is a new facility they're coming up with in Maharashtra, manufacturing facility. They have sales mainly to US, Europe, and they have bill and hold arrangements in certain cases, or they have vendor financing arrangements. If you talk to their supply chain people, they will inform you of these kind of arrangements, or 50% import from China. All of this information, when you have, for example, a new manufacturing location, if you know that they are coming up with a new facility, then probably the CWIP increase and balance may not be unusual for you, because you know that they are kind of increasing their manufacturing facility. Uh, but yes, things like if you look at their income tax effective rate, last year 35%, this year 20%. Of course, you would want to inquire, seems unusual. What is the reason? Why is PBT as a percentage the same as previous year? If you look at probably, the sales have gone down, but the trade receivables have increased. What is the reason for that? We know that there's a bill and hold arrangement, so we would want to know how the accounting and revenue recognition versus inventories and all is taken care of in such kind of arrangements. Your focus area would be that, right? You would plan that. And for documenting all of this, you can use a template. Simply I've just put in a format of a template, that where you put in last year figures, compare it to this year figures, or it could also be your budgeted figures versus current year actual figures, or it could be, if there are interim financial statements available in case of listed entities, what's been the performance for the last, say, 2 quarters or 3 quarters, and then you're comparing it with what you got at the year end. All of that, you can use that kind of information in your risk assessment. Is there a variance? Do you think it's unusual or unexpected given your knowledge? So you need to use all the information that you've gathered through your inquiry procedures, through your ANC procedures, through ANC, I mean acceptance and continuance procedures, other activities of risk assessment. You would probably assess whether it's unusual, unexpected, yes, no, does it have any impact on your audit plan. So the reason for doing all of these procedures is to ensure that whether it has any impact on my audit plan and what do I need to focus on during the audit. And this is only a documentation template. You may change it, but this is what needs to come out of your documentation, that you've assessed, you've done your analytical procedures, uh, basis that you've assessed whether there's anything unusual that you need to focus on during your audit. So this is just a way of capturing your procedures that you're doing in terms of your analytical procedures. Now, moving on to understanding the entity and its environment. What do we do in that basically? We again try and collate what is the industry in which the client is operating. How is the market in that industry? What's the competition? What is the total demand and capacity, price competition in that industry? Is it cyclical? Is it seasonal? uh, you know the product technology, very fast changing businesses and very fast changing technology that has implication on impairment of maybe assets, impairment of intangibles, and all of that. When the product technology is changing very fast, or is it more stable? So the relevant industry is important. Regulatory framework in which the entity operates, is it very regulated? Is there a lot of risk of non-compliance? Other than Companies Act, what are the other compliances that are applicable to the client's industry? For example, it may be regulated by RBI, it may be regulated, maybe FEMA implications are too high because of their business. Taxation, are there government policies that affect the conduct of the business? Environmental implications into industries with a lot of environmental impact. those regulations will come into play, and all those are important to understand to ensure that there is no significant non-compliance, for example, which may put a risk of going concern for the entity. Some laws and regulations are so important. For example, environmental, sometimes they can be so stringent and important that there is a risk that if you don't follow it, you may be asked to shut your shop or shut your manufacturing plant, which creates a threat of going concern. So, knowing that what are the regulatory or I would say laws, regulations applicable to the industry in which your client is absolutely essential. How does your client actually monitor compliances with those regulations becomes absolutely important. General economic conditions could be some others which you should understand. Are there any economic conditions that will impact? For example, a deterioration generally in the economic conditions could lead to, say, impairment of goodwill or other assets which are fair valued. It could have implications on all of that. So gathering this information at the planning stage, documenting what you have gathered and whether it has any impact again on your uh, so when you actually go through and you gather this information, what you need to think in your mind is, okay, this is what the information is, but what impact does it have on my audit plan? Does it indicate any unusual things? Does it indicate any fraud risk? Does it indicate anything that I need to consider in my risk assessment procedures? So, the risk assessment analytics that we did, information that you gather here would also help you in your risk assessment analytics. So, you need to correlate all this information. So, understanding the environment in which your entity is. Now, for example, regulatory. Recently we had seen that all these Chinese gaming companies were banned. Now, all of a sudden, this kind of regulation comes up. If you have a client that is in that industry, there is an immediate threat of going concern on that entity. So, knowing about this, and nowadays there's so much technology, so much information available that you can get a lot of this information by doing a little bit of research on the industry and the market, what's going on there. For example, product technology. We've all seen how Nokia just vanished because they were not investing enough in the product upgradation. So they had almost gone out of business because of that. So understanding that how much a role of technology plays in that, in the business, how important is it? Is your client investing enough to ensure they remain ahead of the curve or ahead in their business? All of that is important to understand, and not only to understand, but in your mind, as I said, you need to keep thinking and documenting. Does it have any impact on your audit plan? What is it that you will focus on during your audit? Similarly, it's saying understanding of the entity and its environment. So the entity specific understanding, like how is the ownership governance, how is the entity structured in terms of debt or equity, how are the operations, what are the revenue sources, what are the production process which the company has, what kind of inter related party transactions do they have, what mechanism they have of capturing all of these important transactions. How is their accounting policies? Is it very aggressive? Is the management taking very aggressive stands on accounting policies? uh, what kind of investments they are doing? By looking at their budgets, you would know whether they are kind of having a budget to invest further in technology that impacts in their business. What are their key performance indicators basis which employees performance are measured? Is there too much um, what do you say, too much linkage of their incentives and all basis sales or basis profits or what that, because that could then trigger a risk of misstatement or overstatement of sales or overstatement of profit if there is too much of employee incentives and their performance being measured basis profits or sales of a company. uh, So all of that you need to understand. Again, you need to assess whether there is any risk flowing through it. There could be risk of fraud when there is too much focus on, when the budgets are too aggressive and there is too much focus on performance of employees based on meeting those budgets, and think those budgets are too aggressive, then there is obviously a window that opens up, or there is where there could be a risk of fraud. Not necessarily there is, but there could be, and you need to focus on that. Whether then you need to focus on cutoff of revenue, or you need to focus on collection of debtors, or and all of that. So that all comes into play. So when you're gathering this information, as I said, you assess all the other aspects, whether when you're developing expectations for analytical procedures, any of the information is going to be helpful there. What are the special areas of consideration during an audit based on all this information? Is there any impact on materiality based on all the information about the entity and its controls or its environment into it? Maybe you determine that materiality needs to be a little lower because of the high risks involved in particular areas. So all of that needs to be corroborated, and then you assess the risk of material misstatement. And what it lastly, the standard on 315 actually talks about is understanding the internal controls. So identification of controls is important. We all know what controls. I think I will not dwell into it too much. But we all are aware that there are enterprise level controls. There are direct controls, there are indirect controls. Direct controls which directly prevent or detect the occurrence of a risk, and indirect controls which indirectly help in prevent. They do not directly prevent or detect, but they help, like code of conduct. Having a strong code of conduct or a risk management, enterprise risk management program, it helps in ensuring that controls are working, the direct controls are working fine. Then there are process level controls at each process level specifically. There are IT general controls that relate to the whole infrastructure and systems and controls around all of that. And if you were to see basis nature, there are basis, the timing of occurrence, there could be preventive controls, detective controls. By nature of their performance, there are automated controls, there are IT dependent controls, there are manual controls. IT dependent are those where you're using reports. Automated controls, we all understand that it's automated in the system, access rights and other things. IT dependent as where you are relying on some report, for example, from the system. So the control is manual. For example, a review of debtors aging report and determining the provisioning amount. That review is done manually, but the report that you're using is a report that is generated from the system. So in these case of IT dependent controls, and we'll speak about it when we are coming to control testing, we need to assess whether the reports that are being used to perform that control, whether there is a reliance on that report. That again depends on how strong your IT general controls are. If not, then whether you do alternative tests to see that the report that management is relying on, because if the report is incomplete, for example, if your debtor's aging report is incomplete, obviously your control about reviewing the adequacy of provisioning is not going to be right. So you need to understand what is the nature of the control. Is it IT dependent? It's automated, it's manual. If it's automated, then do you have enough ITGC controls to actually rely on those controls, automated controls? And by frequency, if you see, there are daily, weekly controls, there are monthly, quarterly, or there could be annual controls. So like depending on the type of control, your reliance, or what would you want to rely on? If you had to say between preventive and detective, probably preventive are more, because they ensure that nothing goes wrong, rather than detective control that only later on detects that something went wrong. In case of automated or manual, probably your reliance would be more on automated. If there are IT general controls, you would want to rely more on automated, because there the risk of errors is not there compared to manual controls. By frequency, of course, more the frequency, the better. But then obviously there are some controls that can performed only quarterly or annually. So the frequency of the control, whether it's adequate or not, also needs to be seen. You can, I mean, something that should be done on a quarterly basis, but you say I do it only annually. Maybe your then comfort from controls will reduce. So frequency also matters. This is just broadly what controls are. I think the important thing is understanding the internal control framework, that is, what we call the COSO framework. Now, this is a very important step in your planning, is to understand what is, if you look at the COSO framework or the components, it's like understanding what is the control environment of the company. It reflects the attitude of or attitude of management, the awareness and actions of management and those charged with governance. What kind of commitment they have to competencies. What is the tone at the top, basically what we call the set the tone at the top, which is very important. What is management's philosophy and style of working? All that, what we generally see as a part of understanding the control environment would be, we'd be seeing whether they have whistleblower policies in place. They have a code of conduct which they do communicate to the employees on a regular basis. It's not only when an employee joins, but on a regular basis there are sessions, and there is a refreshment of the code of conduct of the company. The whistleblower policy the employees are aware of, so that if they come across anything that is not correct, or that is, they feel it's not right, there is a whistleblower mechanism where employees feel safe to report it. So if there is any indication, if any person thinks that there is some fraud happening, or there's some, they should be feeling safe to go and report it. That is ensured if a company has a robust whistleblower policy. A company that does not have that, probably, employees either don't know or they fear of reporting things. So those kind of things, organization chart, everyone is aware of what the organization structure is, what is their roles and responsibilities. All of that you assess in the control environment. Then you see the risk assessment process of the company. How does the client actually assess, identify the business risks? How do they address the business risks? What actions do they take for the business risk? An example of that would be seeing whether the company has an enterprise risk management program wherein they identify what are the business risks, what actions they need to take, what is the they review it on a regular basis to see what actions have been taken so far versus what they had planned to take. Then you look at control activities, that is, whether there are proper authorization mechanisms, there are performance reviews on a regular basis, transactions are approved, there are physical controls in the systems around assets, and there are system access controls proper. All of this are around the control activities, sorry, which are there on the client place. Then you have information communication, that is again on your procedure for capturing the data, storing the data, reporting the financial data, what kind of processes and controls they have around initiating those records and processing the transaction, etc. What kind of internal and external communication they have with regards to significant matters and rules responsibilities. And the last in the COSO framework is monitoring of controls. Does management have adequate monitoring that the controls, all of these controls that they have set are, designed appropriately, they are operating, and that could be ways. The ways are, obviously they have an internal audit function that does the check. There's adequate supervision of manager. Audit committees are in place to ensure all of that. So understanding the control environment is essential, because as we said, risk of material misstatement is a function of inherent risk in an account balance, which is inherent in certain type of accounts, and the control risk, that these controls which the management has put in place will fail. What is the risk of that? By understanding all of this, you would identify the risk of material misstatement, which is absolutely essential and important for a purpose of our audit plan. So now that risk of material misstatement, so risk of material misstatement, you need to see at an assertion level. It You have to identify at assertion level. We know all our what our assertions are: accuracy, existence, occurrence. At that assertion level, for each class of transaction, for account balances, and for disclosure purposes as well. Um, Also, if there are any significant risks identified out of this activity of assessing risk of material misstatement, you would identify if there are any significant risks, like because of any significant transaction outside normal course of business, or there is too much subjectivity and estimates involved with and the volume of those transactions are too high, or there are significant related party transactions. All of that, leads to identifying if there are any additional significant risks. While there are some presumed risks, significant risk, that is in revenue and management override, but in addition to that also, if there are any other significant risks that you've identified, basis your risk assessment. So this completes your identification of risk of material misstatement. Now, what do you do next is you plan your responses to those risks, assessed risks. So you would plan basically an overall response, which is, we discussed at the beginning also. You would assign appropriate personnel, you would ensure there's adequate supervision, timely review of certain things, overall audit approach, your use of professional skepticism. All of that you need to consider as an overall response, but in addition to that, you need to plan your responses at each assertion level. How would you plan your responses is you determine what is the further audit procedures that you would do, what kind of audit strategy you would apply, whether you would want to do a controls based audit or a substantive based audit only because control environment is not so strong maybe, or in certain areas it's not strong, so there you want to do more of substantive procedures rather than controls, reliance on controls. So all of that is what you need to plan ahead. So basically, scoping of your FSLIs. You would scope in which are your significant FSLIs based on materiality, risks that you've identified. Certain disclosures are very important. So you would identify what is the scope, what are the financial statement line items which you would scope in. Then how would you address those? Would you do test of controls? Will you do substantive, as I said? Now, test of controls, I think when we are testing controls, these are some factors which I've listed down, which you need to keep in mind, that you need to do evaluation of the design of the control first. So, whether it is appropriately designed, whether the design is such that it will address the risk for which it is implemented, then we would only test which are the relevant controls for us from a financial statement reporting perspective. There would be controls which are operational in nature, which really do not have impact on this. We do not need to test them. There can be two or three controls addressing the same risk. You need to assess and see which one is the most relevant for you to test. You need not test all three controls. You may only test the one control out of which will help you in assessing that the objective or the risk which it plans, all the three controls are meeting one, um, or addressing one risk only. So you can test any one control which you feel is most appropriate. You may test that. So test only the relevant controls. uh, After you have evaluated the design of the control and you're comfortable with it, then you test the operating effectiveness. What does operating effectiveness mean? Is to test whether that control was operating throughout the period. So, on a full year basis, it was operating throughout the period or not. Whether it was operating in the way it was designed, or sometimes it has happened a design in a particular way, it is operating in a particular way, and it's not really meeting the objective then, because actually when the control is operated, they're doing something different from what they had designed the control as. Then how much you want to test, what is the level of comfort you need from controls? Do you need high level of comfort, or you need lower level of control? That's how we call filling up our bucket of assurance with controls, high or low or moderate, and then with substantive procedures. So those are decisions. Then when do you want to test the controls? Do you want to test them at the interim stage, or you want, or only at the year end? Recommended is we do interim work on controls so that if there are any deficiencies, those are discussed with management. Management has time to remediate those deficiencies and those controls, because with IFC reporting now it's important to also report on controls. So irrespective of whether you're going to take comfort from them or not, you still need to report on the controls. And if there are significant, if there, the deficiencies you note are material, then you may have to report the material weaknesses in your reporting, IFC reporting. And there, obviously, management never likes last minute surprises. And also doing an interim test and communicating with them that these are deficiencies, it may impact reporting. They also have adequate time to remediate it. All that may be important. But when we do interim testing, it is very important that we do a year-end update for all those controls. Um, then again, I think use of evidence that, or the controls that we've tested in the previous year audits, are also possible, given that there is no change in the control and it does not address a significant risk. So if there are no changes in the control, no changes in the people who are operating those controls, the risk of errors in those controls is low, you may use the audit evidence you obtained last year and not do a full control testing of them again in this year, but you need to do it once in 2 or 3 years, definitely. And if it addresses a significant risk, you need to do the testing every year. You cannot use previous year work to do. And then lastly, if you note exceptions in your control testing, how do you address them? Like, depending on whether they are significant and they may cause a material misstatement, you may want to report it. If there are other mitigating controls, you may want to rely on those mitigating controls, and and then decide on your overall comfort on controls. So identifying each exceptions and dealing with those exceptions is important. And after you've done your test of controls, or and the strategy on controls, you see how, what level of substantive procedures you need to do. Now, substantive procedures are required irrespective if the classes of transactions are material, the account balances are material, if there are significant estimates or there are disclosure requirements, you cannot just rely on controls and say that you've got adequate comfort and you don't need to do any substantive procedures. You will have to do them if they are material, significant estimates, judgments are involved. Again, in substantive, you can do test of details, that is, the samples testing and other things, or you can do analytical procedures, a combination of that basically. Again, only analytical procedure may not give you enough comfort. You may have to do certain test of details in combination. In case of confirmations, there are many areas where we do external confirmations required, like bank balances, relationships with banks, accounts receivable balances, inventories with third party. All of this, you get a very high level of comfort through external confirmations. But there are certain assertions, like, for example, a recoverability. When you're doing valuation, recoverability of debtors, there external confirmation alone may not give you comfort. I mean, it will be less useful in terms of recoverability. While the debtor may, for example, say that yes, this is payable, but the financial condition of the debtor is not good. So it still has a risk of recoverability, even though the debtor has confirmed. So sometimes those external confirmations may not give certain, comfort over certain assertions like recoverability. So you need to keep that in mind. And lastly, on the financial statement closing process, that is journal entries, and there is a significant risk of management override of controls, where management obviously is in a position to override certain controls. So journal entry testing, book closing entries which are passed, reviewing them is absolutely essential to ensure that nobody has, overridden controls and made adjustments to the financial statements. So any, what we call post closing entries that are passed, we need to look at them carefully. There are rationales for passing those entries. We need to test those. Obviously, again, as I said, after every slide, I would emphasize that documentation of all of this is absolutely essential. Uh, Work not documented is not done, and it will become absolutely uh, difficult to justify to regulators that we did make an adequate audit plan before we started the audit if all of this is not documented. So I think that is all about planning. I think if there are questions we can take, and if there is some time, there was a small case study which you can read and uh, you know tell me on how you would, what are the kind of audit plan, how would it impact your audit plan. So basically this is a technology company. It specializes in developing software solutions for various industries. It has experienced rapid growth over the past few years. The company's financials, uh, year end is 31st March, annual audit will start in April. Some numbers: revenue 3,500 crores, its headquarters are in Bangalore with 2,500 employees. It has subsidiaries, 5 subsidiaries across Europe, Asia, America. They have some key products like ERP software. Now, your firm has been doing this audit for the past 3 years, so it's not a new client. And some other information based on your initial inquiries that you've identified is recognition. There are complex revenue transactions. Company has recently adopted 115, India's 115. Um, in terms of, there has been changes in key management personnel, including CFO has changed during the year. Of course, they have heavy reliance on IT systems, and they've acquired two small companies during the year which have not been fully integrated. Now, if you can think of all this information, how would you really plan your controls work? How would you plan your, what kind of risk of material misstatement do you think basis this information? I know it's limited information, maybe you need more information, but uh, resource allocation, how would you design your audit procedures? If you can just take 5-10 minutes and put down some comments which you think you would consider, then we can have a look at that. So yeah, are there any comments? I'm not able to see. Would it have any impact on controls, your evaluation of internal controls, given the information that there have been changes in key management personnel? Anybody? I don't see any comments. Is it that I can't see? Dilip, are you able to see any comments?
Let me check. 1 minute. No, since there are general comments. Yes.
Yeah, I think risk of ensuring application of uniform accounting policies, given that there are subsidiaries and there are smaller companies that have got acquired, it is absolutely essential to see that accounting policies are synced with the group. Um,
Yes.
Hello, sorry, I got disconnected. So yeah, so I can see some. Sorry, am I audible?
Yes, ma'am.
Yes. Yes, I can see some comments now that risk that controls may not operate effectively during the year. Absolutely right. I think that there would be challenges given that senior management, there are a lot of changes in senior management. Uh, Testing of business continuity plans in case of disruptions. Yes, I think one important also is with respect to revenue recognition with a new standard adoption. Would be a focus on ensuring we are reading contracts, given that Ind AS 115 is complicated. You would also see whether what kind of team members would you deploy on an engagement like this, whether the team member has good understanding of Ind AS 115, complexities of Ind AS 115. So deployment of your team is also essential. Understanding that the company understands and they have appropriately changed controls with respect to revenue recognition. uh, they've updated their controls because in India's 115 revenue recognition is, I mean, dependent on whether control is transferring, at what point in time it's transferring, whether it's overtime, point in time, all of that. So whether the controls of the company have been adequately updated to ensure this is what you will focus on. So these are certain things that you need to actually consider when given this information that you gather in planning. So I think with that, I think I am done with my presentation. If there are any questions or anything you would want me to additionally discuss, happy to do that. So actually, I think I'll stop sharing so that I can see any comments. So I think that was all from my end. So I think with respect to haircut to arrive at performance materiality, again, it is a judgment. Um, there are different practices, yes, generally in a range of say 20-25% haircut, 10 to 25%. I think haircut is generally what is practiced across industry that I have seen for a haircut. So it really depends if it is a public limited company, if it's a listed entity, and so the haircut would be higher because you have got a wide variety of users over there. If it's a close-ended private limited company, a subsidiary of a holding company, you may have a lesser haircut. I mean, to an extent of 10% only for haircut because their users are limited. You know what their focus is. You know what is important to them and material to them. So, yeah. But generally, I had seen 10 to 25% haircut being used for performance materiality. Yes, I think haircut would change not only with what controls you have comfort, so high controls environment with your past experience. If you've seen very little audit adjustments and a strong control environment, you could use a lower haircut because your confidence level is higher in that case. So you may use a lower haircut. And if there are a lot of misstatements that you've identified, audit adjustments in the past and all, you would generally use a higher haircut because of the experience that you've had of the past. So that's very essential to determine what has been your past history of misstatements and the control environment. Any other questions? Anything anybody wants to add? If you think it's important and maybe I have not, kind of covered it, but you think it's important from a planning perspective, please feel free to add. Uh, So you can do a dual testing where samples can be used for controls because the purpose of a control testing and the purpose of substantive is different. So maybe certain samples you can do a dual purpose testing, that is possible. So I think, Dilip, if there are no more questions, then we can end the session.
Yes, ma'am.
Okay, then I think I would like to thank all of you all who have taken time out for the session today. I enjoyed really giving the session. Hope it was helpful to you all as well. And looking forward to more such presentations.
Yes. Thank you, ma'am.
Good evening, all. It's my great honor and privilege to deliver the vote of thanks for today's enlightening session on deep dive on effective audit planning and case study with use of template, which is organized by WRC. First and foremost, I would like to extend my heartfelt gratitude to our esteemed speaker of the day, CA Disha Maheshwari, madam. Thank you, ma'am, for your comprehensive and insightful presentation, and your expertise and your practical approach to audit planning have provided us with valuable knowledge and tools that we can apply in our professional endeavors. And I would also like to express my appreciation to WIRC team for organizing this informative session. The planning and execution of this event have ensured that we all gain the maximum benefit from today's program. And at last, a special thank you to all the attendees and participants for your active participation and engagement. So thank you once again, everyone, for making this session a success. And we look forward to your continued participation in our future events. Thank you. Thank you very much all.
Thank you. I think there is a question on the presentation, so that I will coordinate with WIC. I think there would be a recording of this available, right? On the
Yes, madam.
Yes,
Obviously.
recording is available.
Okay. So you would have the presentation then through that, yeah.
Okay, ma'am. Thank
Okay.
you.
Thank you.
Thank you, ma'am.
Thank you.